Thank you for your patience. I am Kathy Neifeld, one of the 4 principals at Agency One. Along with my partners Ed Lesher, Dennis Bartos, and Gonzalo Garcia, we are pleased to welcome everyone to the 6th installment of Agency One's 2021 bi-weekly webinar series. Since the beginning of the year, we have had webinars on estate and income gift tax planning and asset protection under the new Democratic administration, featuring attorney Alan Brown and advanced markets consultant Randy Zipsey. We had a webinar on changes to the Internal Revenue Code section 7702 and the impact that these changes will likely have on permanent life insurance products with Bobby Samuelson. We had a webinar on digital marketing tools, resources, and strategies that you should be using to help drive more business with Samantha Russell. We also had a webinar on premium financing with US Bank and Taylor Miller. And finally, we had an underwriting webinar featuring our very own Dennis Bartos, Jessica Karakoff, and Julie Melendez. All of the webinars, with the exception of the one on section 7702 with Bobby Samuelson, have been recorded and are on our YouTube channel and also on the Agency One website for your convenience. For those of you that are new to Agency One, welcome. A brief introduction. We are a very high-touch, exclusive brokerage general agency. But what does exclusive mean? We have a platform called the Agency One 100, and one of our guiding principles is to work with a small, select group of advisors in a very large way. The advisors that are part of this group are like-minded, highly successful, creative, and driven. We focus on life insurance and fixed annuities. If you have other needs like disability or life settlements or standalone long-term care, we have strategic relationships with the best providers in the industry to refer you to. We truly have the premier underwriting department in the industry led by Dennis and advanced markets and case design departments led by Gonzalo. If you want high-touch, personalized attention, advocacy, and want to feel like you and your cases are important, then Agency One is or should be your brokerage general agency. If you would like to learn more about us, how the Agency One 100 platform and how you can become a part of it, or if you have a case you would like to discuss, please reach out to me, Gonzalo, Dennis, or Ed. I have some additional important announcements about what Agency One has planned for the next few weeks, and I will be sharing them with you at the end of the webinar. Now on to today's featured speaker, Anirban Basu and the Chamber of Data. Mr. Basu is the chairman and CEO of Sage Policy Group, which is an economic and policy consulting firm in Baltimore, Maryland, that he founded in 2004. He is among the most recognizable economists in the industry, in part because of his consulting work on behalf of numerous clients, including prominent developers, bankers, brokerage houses, energy suppliers, law firms, and business associations. Mr. Basu is going to present current economic data and analysis, juxtaposing the pre-pandemic and pandemic world, and then offer a forecast for the post-pandemic environment. Mr. Basu will focus on labor markets, financial markets, real estate construction, consumer spending, business investment, international trade, and government finances. For those of you that missed the economic update that Mr. Basu provided for Agency One last year, I think you're going to quickly recognize that he has a real love for J.R. Tolkien and the Lord of the Rings, Agatha Christie, James Bond, and English football. Mr. Basu will try to respond to any questions that have been asked at the end of the presentation. So please submit your questions through the question feature on the Zoom question bar. We will be monitoring them as they are being submitted. Mr. Basu is going to speak for about 40 minutes, and then we will address your questions. This session is being recorded, and now I am going to turn this session over to Anirban. Please take it away.
Kathy, delighted to be with everyone today and delighted to be with Agency One. Hopefully you can see my screen. Hopefully you can see my presentation. Yes, the presentation is entitled Anirban Basu and the Chamber of Data. This is a Harry Potter themed presentation. When last I was with Agency One, it was, I believe, Lord of the Rings, but today Harry Potter, it's about wizards and witches, so on and so forth. You'll see that theming throughout my presentation, whether you like it or not. I hope you don't hate it. So I think we can agree from an economic perspective that the single most influential factor shaping outcomes is COVID-19. It is still the case. And of course, this has been a shared global experience. It has ushered forth behavioral changes, and those behavioral shifts have resulted in some dramatic changes in economic outcomes over time, with some industries benefiting from these changes and other industries not so much. Now, as I say, it has been a global experience, of course, a global pandemic, and yet the response of various people around the world and various governments around the world has been very different to this shared pandemic. And that helps explain why the economic outcomes have been so different around the world. This is a map from the International Monetary Fund. It's a reflection of 2020 economic growth or lack thereof. On this map, green is good because green signifies growth in 2020. And there is some green here, most notably in China. China, home, as everyone knows, to the second largest economy in the world. That economy grows 2.3% last year. You can see also the Laotian economy grows, the Vietnamese economy grows, east of the Caspian Sea. Nations like Turkmenistan and Uzbekistan generate growth. Guyana in South America, in Western Africa, nations like the Ivory Coast, which I referred to as the Côte d'Ivoire when I was a single man for various purposes. In any case, they grow economically. Some nations really aggressively shut down their economies early in the crisis, shut down their population movement, including China. Other nations, like some of those in Africa, didn't do much in response to the crisis in terms of locking down their populations. In any case, some nations grew, some nations did not. Red is bad. Red means that economies shrank. And you can see that North America shrank last year. And in fact, I can offer you some additional granularity around this. Same data source, the International Monetary Fund. You can see toward the bottom of the slide that 2.3% growth in China. The US economy, according to International Monetary Fund estimates, shrank 3.4% last year. You can see that at the middle of the slide. Now, our own Commerce Department estimates that the loss of economic output last year was 3.5%, but not the worst performer in North America. The Canadian economy shrinking 5.5%, the Mexican economy 8.5%, and North America was not the worst performer. The French economy shrinking 9%, the Italian economy 9.2%, the Spanish economy 11%, and the United Kingdom coming off its worst year since 1709. As many people note, that is was the year of the Great Frost. So last year was a historically bad year for much of the global economy, and of course, including the United States. Now, for me to indicate to you that the US economy shrank 3.5% last year is accurate, but it also misses a ton of nuance. There were times, of course, during which the US economy was horrific last year, but there were also times during which the US economy manifested significant bounce back. This is quarterly GDP growth. Now, the blue-colored bars stretch through the fourth quarter of 2019, and those blue-colored bars are indexed to the left-hand vertical axis. I had to bifurcate the vertical axis, which sounds and is excruciatingly painful. So we came into 2020, as you will remember, with plentiful momentum. The principal concern among many employers back then was, I can't find workers to support growth. Now, the growth ends with the first quarter of 2020 as we shut down the economy. There are four red-colored bars on this chart, the first, second, third, and fourth quarters of 2020 respectively, and those are indexed to the right-hand axis. During the first quarter of 2020, as we shut down the economy, the US economy shrinks 5% on an annualized basis. Now, that in and of itself is a big deal. During the fourth quarter of 2008, which had been the worst quarter of our economic lives, the US economy shrinks 8.4%. So a negative 5% print is nothing to scoff at, but that was merely the appetizer. For during the second quarter of last year, the US economy shrinks 31.4% on an annualized basis, which is why I had to bifurcate the vertical axis. Because if I try to graph a number of that magnitude on a single unified axis, all these other vertical bars, or many of them, simply disappear. And around that time, there was this massive debate in the economics community about whether or not the initial phase of recovery would be U-shaped, L-shaped, Nike swoosh, check mark, square root, hockey stick. It was a V. V for vibrancy or vitality. It was a V. For during the third quarter of last year, the U.S. economy comes racing back, growing 33.4% on an annualized basis, demonstrating that under the right circumstances, this U.S. economy has massive recuperative powers. Now, momentum wanes into the fourth quarter. During the fourth quarter, the U.S. economy grows 4.1% on an annualized basis. And despite that second half of the year growth, it is still the case that the U.S. economy ends the year smaller than it began the year. As I say, the U.S. economy shrinks 3.5% for the year. Now, there are many economic implications attached to a shrunken economy. Let's talk about some of them. Let's begin with a discussion of the U.S. labor market. So one of the other aspects of 2020 was massive job loss. This is monthly job change in America. I've graphed this back to February of 2002 for you, so there are 19 years of monthly data here. The blue-colored bars stretch until February of 2020, and again, the blue-colored bars are indexed to the left-hand axis. February of 2020 represented the 113th consecutive month of job growth in America. It was a month during which the nation added 289,000 jobs. During that 113-month winning streak, this nation added 22 million jobs. We drive the official rate of unemployment down to 3.5%. That was a 50-year low. You'd have to go back to December of 1969 to find unemployment as low as it had been pre-crisis. And just to give you a sense of how long ago that was, the Orioles were good back then. I'm from Baltimore, I know these things. We shut down the economy in March. The red-colored bars begin with March of 2020. And in March of 2020, this nation loses 1.7 million jobs. But that's misleading, because the so-called reference week, the week during which the underlying survey is conducted, was relatively early in March. So a lot of the jobs lost in March didn't show up in the March jobs report. They would show up in the April jobs report, along with some of the jobs lost in April. And in April, this nation loses 20.7 million jobs. Now, if you do the math on that, between March and April, we lost about 22 million jobs, a bit more than that, wiping out all of the job gains from the previous 113 months. We lost that in just a few weeks. And economists surveyed by the Wall Street Journal around that time, mostly economists who work for large US financial institutions, but also some prominent academics, collectively projected that this nation would lose another 8 million jobs in May. But we didn't lose 8 million jobs in May. We added 2.8 million of them, followed by 4.8 million jobs in June, and 1.7 million jobs in July, and 1.6 million jobs in August, and 716,000 jobs in September, and 680,000 jobs in October. Fantastic. Now, as we move toward the tail end of last year, the pace of job growth slows. But again, a V-shaped recovery here, ladies and gentlemen. Sharp bounce back, including, again, those roughly 4.8 million jobs added in June of last year. So again, I'm not suggesting to anyone here that we're anywhere close to complete recovery. If you compare February of 2020 employment versus February of 2021, we're still down 9.5 million jobs. Which sectors lost the most jobs? Leisure and hospitality, not quite 3.5 million of them. That's your hotel worker and your restaurant worker. Government losing 1.4 million jobs. Why? Because state and local governments have to balance their budgets each and every fiscal year with limited exception. And if the revenues are not there, the cost must be cut. And the cost of government often takes the form of human capital, teachers, teachers' aides, firefighters, police officers, garbage collectors, bus drivers. That's who lost their jobs in large numbers. Public sector jobs and private sector jobs. But every major category here lost jobs, including financial activities, and many of you would be classified in financial activities. Now, some regional data. So, we talked about the fact that economic outcomes were different in various parts of the world. That was true in various regions around this country. This is employment growth for the 25 largest metropolitan areas in America. I'm comparing January of 2020 employment levels versus January of 2021. It is a mistitled slide. Why? There is no growth here. Every one of the nation's 25 largest metropolitan areas lost jobs on this year-over-year basis. However, some regions lost a smaller fraction of their pre-existing employment base than others. Who held on to the bulk of their jobs, or at least more than any other region? Dallas, Fort Worth, Arlington, Texas, North Texas, losing 3% of its pre-existing employment base. Who is the governor of Texas? That's right, it's Greg Abbott. Greg Abbott has been one of these governors very keen on keeping his economy open. And number two, Tampa. They just won a Super Bowl. Who's the governor of Florida? That's right, it's Ron DeSantis. Again, one of these governors very keen on keeping his economy open, very proud of responding to the crisis by and large, not responding to the crisis. Number three, San Antonio, aforementioned Greg Abbott. And number four, Phoenix. Who's the governor of Arizona? Correct again, it's Doug Ducey. Doug Ducey, one of these governors, very keen on keeping his economy open. Skipping to number six, Atlanta, Georgia. Who's the governor of Georgia? Everyone knows it's Brian Kemp. Brian Kemp was the first to reopen his economy, happened on April 20th of last year. Now, at the bottom of the second column, you see the regions that have lost proportionately the most jobs. At the very bottom, Orlando, Florida. You say, Anirban, what gives? That's Governor Ron DeSantis of Florida, same state, same governor. What are you talking about? Well, here the issue is the structure of the Orlando metropolitan area economy, which is about theme parks, leisure and hospitality, retail, trade. It's about in-person experience, not about remote work. And number 24, Los Angeles. Who's the governor of California? Well, it's the wickedly handsome Gavin Newsom. Himself could be a Hollywood actor, very aggressive in keeping that economy shut down, not himself shut down necessarily, but the broader economy shut down. That helps explain San Francisco's performance as well. At number 22, New York Metro. Who's the governor of New York? Well, everyone knows this month it is Andrew Cuomo. His counterpart in New Jersey, Phil Murphy, of course, again, very aggressive in keeping that economy shut down. New York was an early stage viral epicenter, along with Cook County, Illinois, Detroit, Michigan, Seattle, Washington, parts of California, so on and so forth. And so governors responded accordingly. It is not for me to say that one approach is better than another. Some governors focused on the economic and employment outcomes. Other governors focused on the public health outcomes. It's for you to decide which approach is better. My point is simply this: such policy making makes major difference, generates major differences in terms of economic outcomes, and you can see some of that reflected on this slide. Unemployment. So as I noted earlier, we came into the crisis with a 3.5% rate of unemployment. By April, that's the big peak you see here of last year, it's 14.7%. Now here I'm offering you some additional granularity. I'm showing you male unemployment in blue, female unemployment in green, and overall unemployment in red. So during the Great Recession, the previous economic downturn, men suffered relatively more in large measure because of the massive job losses in industries like financial services, construction, and manufacturing. This time was different. This was leisure and hospitality. This was retail trade. This was salons and daycare centers, private schools, public educators. And so in April, while the overall unemployment rate is 14.7%, the female rate of unemployment that month was 16.1%. For men that month, it was 13.6%. Now you can see the improvement that's transpired since April of last year, roughly a year ago. Now the unemployment rate by February was 6.2%. And now if you flip this line upside down, and why on God's green earth would you do that? It's because less is more here. The lower the number, the better. So if you flip this line upside down, you would literally see the letter V, again, for vibrancy or vitality, or at least a partial restoration thereof. Now this is somewhat misleading as well. Since February of last year, about 4.3 million Americans have left the US labor force. So if you added those folks back into the ranks of job seekers, the unemployment rate would be closer to 9%, which I would say would be a more meaningful measure of where the economy is at this moment. Nonetheless, evidence of progress here. Now, one of the other implications of 2020 was massive government intervention, and there is more to come. And of course, for life insurance and other insurance professionals, this has all kinds of implications. Let's talk about a few of them. Now, to reinvigorate the economy last year, we had 3 rounds of federal government stimulus. These are listed here. The first one was signed by Donald Trump on March 27th of 2020, the Coronavirus Aid, Relief, and Economic Security, or CARES Act. That was a $2.2 to $2.3 trillion package. That was direct payments to Americans, of course, stepped up unemployment insurance benefits, and paycheck protection, among other things. Less than a month later, Congress passes another stimulus package, including more money for paycheck protection. Those monies ran out very quickly, you will remember. But then for many months after April of last year, no new stimulus legislated by Congress. The paycheck protection monies ran out by August. The stepped up unemployment insurance benefits of $600 a week from the federal government on top of state unemployment insurance benefits, that ran out in July. So no surprise, as the stimulus began to wax and wane, we would lose momentum economically later in the year. So by December, we're actually losing jobs. In December of last year, we lost more than 300,000 jobs. It was, you could call it a mini recession. I'll show you more evidence of that as I go through these slides. And so sensing that the economy was losing its vitality, Congress steps up with another stimulus package, this time $906 billion, helps explain why we added 379,000 jobs in February as the stimulus worked its way through the economy, more direct payments to Americans, more enhanced unemployment insurance, rental assistance, so on and so forth. Now, this is old news. We have more stimulus in 2021, of course. As Joseph Biden, our new president, inaugurated on January 20th of this year, on March 11th signs the American Rescue Plan Act of 2021, a $1.9 trillion package, more direct payments to Americans. These have become very popular, by the way. People like to get payments, as it turns out, more extended federal unemployment insurance benefits. But this time, big news, direct aid to state and local governments. So during the first 3 rounds of stimulus, there was no general fund relief to state and local governments. Don't get me wrong. There was a fair amount of money that went from the federal government to state and local governments, but it was prescribed money. It was to bulk up healthcare capacity for the most part, not for general fund relief. You might remember that there was this raging debate on Capitol Hill suggesting that many people did not want to bail out states like New Jersey and Illinois. We don't want to send money directly from the federal government to state and local governments because we don't want to bail out New Jersey and Illinois. As it turns out, there's a fair amount of antipathy toward people in this country from New Jersey and Illinois, which I think is absolutely crazy, as I think those are absolutely spectacular people, at least those folks from Illinois. Now, of course, this package also includes more assistance for small businesses, public health, so on and so forth, but it's big. And state and local governments will have more money to play with going forward, which should staunch the loss of jobs among public sector agencies in a meaningful way. Now, you could ask the question, and you should as financial professionals, are we being Dumbledore? So coming into the crisis, coming into the pandemic, the national debt had reached $23.5 trillion. I looked at the US debt clock today. We are now past $28 trillion, screaming towards $30 trillion in national debt. One of the things you saw today was that the yield on the 10-year rose to a 14-month high. That helped explain why the NASDAQ was down 3% today. So we are in a period right now of financial volatility as we move from this pandemic world to the post-pandemic one, and all the stimulus is ushering us into that post-pandemic world with lots of economic speed. We'll talk more about that, but also with some significant implications for the behavior of financial markets. Now, some of you may view interest rate increases as very positive, allowing life insurance companies, for instance, to generate more yields, more income from bond investments. Others might find that this is dislocating and could destroy a lot of wealth, as we saw today, at least on the NASDAQ. Now, what about some of the other implications of 2020? Well, many of them. Let's talk about some of the commercial ones. So one of the items that we could observe last year was a massive number of large-scale retail bankruptcies. Here they are, some of them at least. So back in February, before the crisis becomes one in North America, Tier 1 Imports goes bankrupt, closing all of its stores so you can still buy their merchandise online. In April, True Religion, the provider of those excellent jeans that make everyone look slender, they go bankrupt. Then sequentially, J. Crew, Neiman Marcus, and JCPenney go bankrupt in May of last year. GNC, the supplier of those excellent supplements that many people take to build up musculature. I take them to build up my biceps. I still have the arms. I'm an accountant for whatever reason. They go bankrupt, as I say, in June. Brooks Brothers goes bankrupt in July. Lord & Taylor at Hallow Department Store goes bankrupt in August. And then late last year, Francesca's, one of my daughter's all-time favorites. So many of these are my daughter's all-time favorites, judging by her spending patterns. Francesca's goes bankrupt in December. Now, here's the thing, though. Last year was not a bad year for retail sales. We bought a lot of stuff as Americans last year. This is monthly retail sales. 21 years of data here, monthly retail sales. Now, retail sales begin to slip in February of 2020. What's going on in February of 2020? Well, let's do some rewinding here. By February of 2020, you and I have heard about COVID-19. Some people are beginning to withdraw from the economy. They're canceling vacations, not shopping as much for fear of infection, for fear of the unknown. By March and April, retail sales are falling off the table as we shut down the economy in earnest. But lo and behold, what do you observe? By May, retail sales are surging ahead once again. What happened? Well, of course, what happened is we had stimulus. People start receiving their stimulus checks. Some people receive stepped-up unemployment insurance benefits. Many people didn't lose their jobs. So income is still flowing into the household, but it's not income that's easily spent because the malls are closed, the theaters are closed, the ballparks are closed, the restaurants are closed, and there's only so much Grubhub you can order. As the economy reopens, those savings that had amassed on household balance sheets turn into expenditures, the economy takes off. We had 4.8 million jobs in June. By June, retail sales are actually above their pre-recession peak, and then they keep taking off. You can see that rise through October. By October, things start to flatten out again. And in November and December, retail sales begin to slump. Again, that mini recession late last year. Now, we got more stimulus passed in late December. So guess what? January retail sales take off, and February is reasonably strong relative to history, though weaker than January. So, we had 3 bad months of retail sales last year, and yet all of that bankruptcy. How does one reconcile these things? Well, some companies, of course, came into the period financially weak. But here's another factor. Who won retail in 2020? This is U.S. retail sales by type of business, February of 2020 versus February of 2021. Who won the last year? The internet, of course, e-commerce, Amazon. Jeff Bezos won. He's done so well for himself that he doesn't have to be CEO of Amazon anymore. I think he probably has enough by now to retire on. Now, some brick and mortar retailers did pretty well too. Sporting goods, hobby, book, and music stores. What is that about? That's about the sale of Peloton bikes. If you couldn't go to the gym, you brought the gym into the house. Peloton bikes and other exercise equipment. Building material and garden supplies dealers. What's that about? That's your Home Depot and your Lowe's. So we spend more time at home. And so guess what happens when you spend a lot of time at home? You notice everything that's not right with your home and all that room for improvement. So look at the stock price of companies like RH, Restoration Hardware. You better believe that a lot of people are buying furniture because they're sitting on chairs and saying, you know what, I don't like this chair anymore. I'm buying a new one. Same thing with Lowe's and Home Depot. A lot of amenities put into the house. We're spending so much time in the house. Now, where do we see the loss in retail vigor? Food services and drinking places at the very bottom of the slide. Food services and drinking places. Most human beings refer to that as restaurants and bars. We economists call that food services and drinking places, which is one of the many reasons that many of us have never been on a date. Clothing and clothing accessory stores. What's that about? We're not in each other's presence. We don't have to work so hard to look good. We can't see each other. I mean, question for you, am I wearing pants? You don't know, and I am not telling. Now, what about restaurants? Another source of massive job loss in America. So this is daily data. So one of the things that people have been interested in is looking at high frequency data. So the economy is changing so rapidly that simply waiting for monthly data or quarterly data is not that satisfying. So this is daily data that comes from Open Table on restaurant reservations for seated diners. Now this green line represents year-over-year percentage change in restaurant reservations. Now you can see here that by March and April of last year, we're at negative 100%. We shut down the restaurant industry completely. Now my staff in Baltimore created this slide for me. They're mostly people in their 20s and 30s. And they took the vertical axis down to negative 120%. I need to tell them at some point that the most you can go down to is negative 100%, but set that aside, that's an internal staffing issue. Now, you can see the bounce back in retail activity in May into June, but then what happens? The progress flattens out. Why? The second surge in viral infections, this time the American South, Florida, Georgia, Texas, Arizona, Southern California. Then after July, viral infection rates start to slow down once again, and things start to get better again. So the big peak is in the middle of the slide. That's Labor Day weekend. So a lot of people went to restaurants on Labor Day weekend, but then after Labor Day, because so many people hung out together, what happened? Another surge in viral infections. And restaurant reservations start to tail off. Now you see some spikes toward the end of the series there. One of them is December 23rd, that's the day before Christmas Eve. And the big spike you see there, where we almost got back to last year's level, is New Year's Eve. A lot of people went out for New Year's Eve. But after that point, very soft recovery here. So people are waiting for those vaccinations, and still the demand side of the economy is reluctant to fully engage, at least the brick and mortar part of the economy. Let's talk about real estate. So if you're familiar with the Harry Potter books and movies, you know that every student admitted into Hogwarts is a school made famous by those books and movies, every student is allocated into one of 4 houses. So there's Hufflepuff, there's Gryffindor. Harry Potter himself is a member of Gryffindor House. I'm from Baltimore. And wizards from Baltimore are always in Ravenclaw. It's just the way it works. I'm not making this stuff up. It's just how it goes. There's some other rules, like, for instance, any wizard from Pittsburgh, they're always in Slytherin. It's just the rule. I'm not making this stuff up, but if you don't like it, you can take it up with Hogwarts administration. Now, one of the other aspects of 2020 was a profound decline in interest rates. Everyone in this audience is aware of that. Here I'm showing you 2 interest rates of interest, the 30-year fixed mortgage rate in blue and the 15-year fixed mortgage rate in red. And of course, as everyone knows, along with other interest rates, mortgage rates fell last year. I don't think it would surprise anyone in this audience that home prices were rising prior to the crisis. Well, of course they were. The inventory of unsold homes is low. Mortgage rates are favorable pre-crisis. We're adding tons of jobs. Unemployment is low. Wage growth is rapid. I think one could view it as somewhat surprising that the pace of home price appreciation has accelerated during this crisis. This is the S&P Case-Shiller U.S. National Home Price Index. And so for people with assets, their financial portfolios have expanded, probably. Their home values have expanded, probably, based on national trends, based on the broader market performance. Really quite remarkable. Now, what happened? Why is this happening during the midst of a pandemic, one that has cost us nearly 10 million jobs on a year-over-year basis? During the crisis, people have wanted to more aggressively social distance. Easy to do that from a home than an apartment building, particularly one with an elevator. More people want more space attached to their residence because they're spending more time at home and they want dedicated space for that home gym or home office. You know, we're all trying to look good on Zoom. I'm trying right now. I don't know if you can tell. And then, of course, demographics. The millennials are at last coming of age. They're growing up. The oldest of the millennials will turn 40 this year. So you take all that into account, the mortgage rates, demographics, behavioral shifts, and there was a real move to home ownership. Now, that generates all kinds of different responses from the economy. One is on the supply side. So this is U.S. residential building permits. It's one of a number of leading indicators I will show you as I move toward the tail end of this presentation. Now, the segment of interest here is the red segment. That's single unit structures. It's a leading indicator because a builder has got to pull a permit before they build something. So it reflects an intention to build, to construct. Now, prior to the crisis, there was this rise in single-family permits. The housing market was getting stronger pre-pandemic. Then during the early stages of the pandemic, permitting tails off for a number of reasons. But you can see here, again, that V-shaped recovery. So now I've shown you some things. I've shown you gross domestic product, jobs, unemployment, retail sales, all manifesting along with building permits here, that V-shaped recovery. And you can see your permitting in general has gotten stronger over time. So by August of last year, home builder confidence is at an all-time high. They can see what's happening. There is a massive movement into the suburbs, and there is not much unsold inventory available to purchase. This is net migration, 2019 versus 2020. This is in millions. You see the red colored bar there? That shows you the 2 million people that moved out of principal cities last year. Where did they move? To the suburbs. The blue colored bar, 3 million people moving to the suburbs. Some folks from rural areas, many people from urban ones. And that migration has many, many implications, including on the value of property. So this is observed rent declines in major US cities between March and December of last year. Look at the left-hand column here. San Francisco rents down 27%, Seattle 22%, New York 20%, San Jose 15%, Washington 15%. Now, rents are not declining everywhere. The right-hand column, less expensive places like Memphis, Virginia Beach, and Colorado Springs, rents are holding their own. What's going on here? We economists have focused a lot on the migration from cities to suburbs, we focus less attention on the migration from more expensive areas to less expensive areas. Why are expensive areas expensive? Often it's because of proximity. They offer lots of jobs proximately. They offer lots of shopping, lots of entertainment. But in a world of greater remote work, in a world of e-commerce, in a world of streaming Netflix, proximity isn't quite as valuable. And you can see the effect of that on some of these rents. Here's another way of looking at things. This is observed rent declines in cities versus suburbs in 2020, month by month by month. Where do you see the big rent declines? The dark purple line reflects what's happened in principal cities. That's not just your New York and San Francisco, Chicago, Nashville, Austin, Boston, so on and so forth. Again, in some of these cities, rents have not declined so rapidly. Austin, Texas as an example, but in many of these principal cities, they have. Now, the light purple line here relates to suburban cities. So I'm from Baltimore. So our suburban cities are the likes of Ellicott City, Columbia, Towson, Owings Mills, Hunt Valley, Pikesville, Catonsville, Westminster, Bel Air, Severna Park, Annapolis, Glen Burnie. I could go on. I think I am. The point is, all of these major cities are ringed by suburban cities. That's not where the rents are declining, and that's therefore not where the property values are falling. It's in those principal cities where proximity or the value thereof has very much been negatively impacted. What about commercial real estate? Let's talk about that. So this is one of the favorite leading indicators for commercial construction. This is the Architecture Billings Index. So it's a leading indicator because if architects are busy upstream, construction firms will be busy downstream. At least those construction firms that work on projects involving architects, like apartment buildings, hotels, office buildings, shopping centers. So you see the 50-yard line running east and west across that slide. Any reading less than 50 means that architects are less busy this month than they were last month. Well, you can see the January reading was 44.9. That's less than 50. So in January, architects were collectively less busy than in December. In December, less busy than in November. November, October, September, you get the point. So design work is down right now. And why is that? Well, in the world of remote work, we don't need as many new office buildings. In the world of Zoom meetings, we might not need as many hotels serving business travelers. In a world of e-commerce, we don't need as many shopping centers, though we might need more fulfillment centers and data centers. So one of the reasons architects are less busy relates to what was built. And I don't know how many of you operate in the property casualty space, but part of this dynamic is driven by what was built and how much of it was built prior to the pandemic. So as defined by the US Census Bureau, there's 16 segments of non-residential construction in our country. All 16 are represented on this slide, and these horizontal bars represent the percentage change in construction spending for the 5-year period spanning from February 2015 to February of 2020. Now, why do I stop with February of 2020? That was the last pre-pandemic month in North America. So what you see that we built a lot of prior to the pandemic, lodging, that's new hotel room construction. We built a ton of new hotel rooms just before this pandemic. And now we can hold meetings online, obviously. We could do that before, but now we've become used to it. Almost everyone's accustomed to Zoom at this point, or go to webinars, so on and so forth. And of course, you can save a lot of money not having to book a flight, or not having to book a hotel, not having to book a rental car. That's a lot of money that can be saved. Number 2 here is office. We built a ton of office space just before this pandemic. And here's one of the things that we learned during the pandemic. Many people are as productive or more productive working from home than in the office. That's one of the things we learned. That was not conventional wisdom coming into the pandemic. So as it turns out, the office has lots of distractions. We are human beings. So what's the first thing that many of us do as we get into the office? We start contemplating other human beings. It's a natural thing to do. And then we go to the water cooler and start talking to some of those human beings about some of the other human beings. We might have some water. Then coffee break number 1, coffee break number 2, coffee break number 3. Free Splenda, it's irresistible. And then an impromptu staff meeting of little value whatsoever, and then lunch. And then after lunch, of course, filling out your NCAA bracket, not once or twice, but 16 or 17 times because you're trying to win, and it's hard to figure out if Tulsa could beat St. John's. So now, don't get me wrong, there are distractions in the home, and we know what and who they are. Neighbors, pets, children, daytime soaps, sports center. But the point is, much less demand going forward for new office construction. And one of the very interesting things to see will be how many of us go back to work 5 days a week, and how many of us insist that we have at least a few of those days to work from home. So you can see the effects of some of this on more recent data regarding construction spending. So this is same setup, same 16 segments, but now for the 1-year period spanning from January of 2020 to January of 2021. January of 2021 is the last month for which we have these data. If you look at the very bottom here, lodging, that's hotel room construction, down 22.5% in terms of spend. At the middle of the slide, office, down 4.5%, but that's misleading. Why? Because the office category also includes data centers. And data centers are feverishly under construction along with fulfillment centers. So traditional office space, that's where you see the loss in volume. Okay, enough of that. Let's get to the forecast so we can get to Q&A. Let me do some crystal balling for you. So broadly speaking, the economy is comprised of demand and supply. That's it, demand and supply. And the bulk of demand in the US economy comes from the American household, the US consumer. It's why we spend so much time trying to understand consumer psychology. Are they happy? Are they confident? Here I'm showing you the University of Michigan's index of consumer sentiment. So when the folks in Michigan are not being hammered by Ohio State, they produce this index. And what it shows is very predictable, that yeah, consumers are feeling better about the economy than they did, let's say, back in April or May, during the earlier stages of the pandemic, but relative to a long-term history, they're still a bit ill at ease. They're still concerned. They're still waiting for their vaccinations. They see that gasoline prices have risen recently. They see that if they're a would-be home buyer, they see that home prices have risen, and it's harder for them to amass that 20% down payment. So there's all kinds of things that work, and of course, many folks are still out of work. Now, what's interesting about this to me is that, in fact, I would make the argument that household balance sheets have never been in better shape. Now, don't get me wrong, not everybody's balance sheet. So I know there's lots of food insecurity in America, that more people are having to go to food pantries to eat. You understand, I understand that many people have lost their health insurance. More people have found their way onto the Medicaid rolls, for instance. We understand that there are a lot of people who are facing eviction once these various moratoria are lifted on evictions. But collectively, in the aggregate, macroeconomically, a lot of households have taken this opportunity to amass massive amounts of savings. Here's the US savings rate. This is savings as a percentage of personal disposable income. This is largely a reflection of the money that people take from their paychecks every 2 weeks and set aside into some account. Could be a 401k, could be a savings account, but they're not spending it right away. So coming into the crisis, the US household savings rate is around 8%. By April, that's a big peak you see here, April of last year, it's 34%. Again, what happened? Income is coming into the household, stimulus, unemployment insurance benefits, jobs, but it's not money that's easy to spend. So savings get bottled up in the household. As we reopen the economy, albeit just partially, those savings turn into expenditures, the economy takes off. We had millions of jobs during the summer and into the fall. But as late as January, the savings rate is still a lofty 20.5%. And now here comes more stimulus. The newest act, the American Rescue Plan Act, wasn't signed until March 11th. So more stimulus is coming on top of this pre-existing volume of savings. So I'm not so worried about the demand side of the economy. That's pretty strong. The issue right now is the supply side of the economy, because still a lot of economic activity is locked down. And this is very much affecting the prospects for small businesses in the near term. This is the National Federation of Independent Businesses Index of Small Business Optimism. Question, Small Business America, is it a good time to expand your business over the next 3 months? Answer, it is not. We don't feel that level of comfort right now to expand our business. Only 6% answered yes to this question of small business survey. So for many of these small businesses, expanding at this time would mean getting back toward what they had looked like back in February of 2020 before this all got started in North America. But even with that, they're not ready yet. So the supply side is still constrained and the demand side is waiting. Now, I think we can agree And this is my penultimate slide. So give me 2 more minutes and then we'll go to Q&A. But I think we can agree that this was a one-of-a-kind event in American history. We can talk about polio in the 1950s, the 1918 Spanish flu, more modern variants like Zika, Ebola, H1N1, SARS, and MERS, but this was unique. But we have had other advanced societies that have experienced pandemics, and we know what the response of their economies was to those pandemics. This is the economic impact of past pandemics. This comes from Goldman Sachs. Now, too many lines on here by half. I just want you to fixate on one line on this graphical element. It's a light blue colored line that goes way up to the top and back down again. You see that line? Hong Kong, SARS, 2003. Hong Kong, SARS, 2003. You see the skinny line at 0%, that horizontal line? That's a stand-in for the pre-existing rate of economic growth. So what happens as a pandemic strikes a society? Growth goes below that prevailing average. Well, of course it does. And first, the pandemic strikes tourism and travel, but then real estate and construction. It becomes more pervasive in its effects on the economy, so things become more deeply negative. That makes sense too. But then lo and behold, what you observe, ladies and gentlemen, a sharp bounce back in economic activity. You see the letter V. You see lots of V's on this chart. You shut down the economy and you reopen it. Now, for us Americans, it hasn't been so simple. Why? Because we were not one and done like the folks in Hong Kong in 2003. The virus has kept coming back at us. Right? Summer surge, surge after Labor Day. So the economy has not smoothly broken away. But now with these vaccinations proceeding apace, Pfizer, Moderna, now Johnson & Johnson, soon Novavax, maybe AstraZeneca. With that happening, the demand side becomes more willing, the supply side becomes more able. This economy is about to take off. Final slide. For an economy to flourish, both demand and supply sides of the economy must participate. With additional stimulus forthcoming, demand gets a further boost, but supply continues to be constrained by ongoing lockdown measures, and not just in America. Not just in America, not just in New York. You can see what's happening in Spain and Portugal, Paris, France, England, Ireland, South Africa. The result is that the US savings rate, indeed the global savings rate, will continue to climb again, and it's doing that right now, spring-loading the economy for rapid economic growth once vaccines become more broadly available. So the back half of 2021 is setting up to be absolutely spectacular for economic growth. This back half of 2021, the second half of 2021, will be the fastest economic growth I think you will have observed in your lifetime. Unless you've been in Dubai on occasion or something like that, but this is going to be unbelievable. However, I still believe there will be a day of reckoning, and for those of you who are financial planners for people of means, this is a problem. I think there will one day be a day of reckoning as deficit hawks come back into fashion. I was taught in economics there is no free lunch. And we've been passing out a lot of free lunches in this country lately. At some point, the bond market is going to revolt. The bond vigilantes are going to come back in style, and the interest rates are going to take off at that point. Or taxes are going to go way up, or the federal government's going to have to curtail investment. Something bad is going to happen at some point in the future. But as I say, that is not the 2021 story. The economic outlook, from my perspective, looks extraordinarily brilliant right now. And with that, let's open it up for Q&A.
Anirban, thank you so much. We have a few questions that came in, and I invite anybody else to submit their questions at the bottom through the Q&A feature. The first question is from Anthony. Thank you, Anthony. Fed intervention since 2008, along with the central banks, has kept the market moving up. When do you see this tapering?
Right, so you might remember, thank you, Anthony, for the question. You might remember in 2013 how violent the response was of the bond market when the Federal Reserve merely suggested that it was going to cut back on its bond purchasing program. It was going to cut back on quantitative easing. Can you imagine at a time when the Federal Reserve's balance sheet is now well over $7 trillion in size, back then it was around $4 trillion or $4.5 trillion in size, what the market response would be? Now, the Federal Reserve has been saying what as a result? We're not doing anything until 2023 or 2024. But is it conceivable that inflationary pressures will force the hand of the Federal Reserve, that they're going to have to cut back on monetary accommodation as the global economy comes storming back later this year into 2022, and we see these inflation expectations continue to build? Is that conceivable? It is. And if you remember 2013, this time could be even more violent for the bond market and equity markets. So I'm going to say this. that the economy is going to come back so strong that the Federal Reserve will not be able to wait until late 2023 to make a move on monetary policy. They're going to have to start raising interest rates and or start cutting back on monetary accommodation well before that time. And that is a risk to portfolios at some point in the future, not necessarily tomorrow or the day after. The bond yields have been rising recently pretty aggressively. You know, they were sitting at 0.9, about 90 basis points coming into the year. We're now at 1.71% on the 10-year Treasury. That's a significant move. But if I'm right that there's going to be even more movement upwards in terms of bond yields, and the Federal Reserve has got to do something to try to curtail inflation expectations, watch out. There'll be a real adjustment in the marketplace. And obviously that would hurt people with assets in particular.
And that was a two-part question. The second part was, debt is at a record high with interest rates at historic low. So how in the world can the Fed raise rates which would make the interest on debt unserviceable?
That's exactly right. Now, as I understand it, the Federal Reserve still has a dual mandate. It's to contain inflation expectations while pursuing full employment. Some people talk about a third mandate of trying to prevent the formation of asset bubbles, but officially speaking, there are two mandates. So the Federal Reserve is not supposed to really think about what this means for Capitol Hill and Congress when it starts raising interest rates. You're right. We are so leveraged as a society, and not just the federal government, households and corporations as well. So small increases in interest rates can make a big difference on the economy when you're so leveraged. And so the Federal Reserve sort of has its hands tied behind its back. It knows that. But if the inflation starts to manifest itself, it has to act. It has to raise interest rates if it wants to stand by its dual mandate. And I think that at some point over the next 2 years, it will have to act whether it wants to or not. And that's because these inflation expectations are going to be taking off, and not just in America, but globally as well.
Thank you. Then we had a question come in from Larry, which said, what are the possible crises that could occur in the future, given the high and growing national debt to GDP ratio?
Right. So look, I was taught there's no free lunch. I was also taught that nations that generate massive budget deficits, central government budget deficits, and massive national debts suffer higher interest rates, suffer higher borrowing costs going forward. And not just the government, everybody. So this notion of public debt crowds out private investment, how does that work? Because when the public sector is borrowing so much money, it raises borrowing costs for everybody. Now, we haven't experienced that for the last 4 decades, have we? So for 4 decades, governments around the world have been amassing incredible amounts of debt, and yet interest rates have fallen over those 4 decades and remain low. In some cases, they're negative. At some point, that equilibrium falls apart. That's my belief. When could that happen in America? I don't really know. Your guess is as good as mine, but I will say 2026. Now, that seems like a strange thing. You said you don't know, and then you gave a specific answer. I say 2026 is a possibility because that's the year that Medicare is set to go insolvent, according to the most recent trustees reports. In 2032, Social Security is set to go insolvent, that trust fund. So around that time, I think that the bond vigilantes will become more active. They're going to demand some evidence of fiscal discipline from Washington, D.C. They're going to demand some adult behavior, and there are not that many adults on Capitol Hill, in my view. So now, we're not Greece. Guess what we can do that the Greeks cannot do? We can print money. So the Greeks, when they had their debt crisis several years ago, had to raise taxes and cut spending. We could do that as a country. But my guess is we're going to print money and monetize the debt, which would, of course, cause bondholders to be paid back in devalued currency, would cause more inflation, higher interest rates going forward. And, you know, it might avert the worst crisis, I suppose, but the markets are not going to love it. And it's not going to be good for equity prices or asset prices generally. So in any case, that's my answer to the second part of that question.
Thank you. What sectors do you think are going to be the first ones to bounce back? And they certainly weren't. I question whether the ones that closed quickest and had the biggest, took the biggest hit. I don't know that they're going to be the ones that you're going to see recover so quickly when people became accustomed to a new normal, so to speak. Like, you're not going to go back to the office to the extent that you did previously. So there are sectors that will recover and sectors that won't recover. What do you think are the ones that are going to recover quickest?
Yeah, I think that consumer discretionary will recover the fastest. I think there's massive pent-up demand to go to a baseball game, to see your family in Arizona, to take a vacation with your family, to do all the things that we've been restricted from doing, to go to Hawaii, which was so locked down during this crisis, to get on an airplane. So I really believe that you're going to see this volley of leisure activity later this year. I've been telling people, book your flights now. Book your hotel now. Airfares are already rising. Hotels are already getting booked up, especially the best ones. Remember, the wealthier got wealthier. So if you're looking at an exclusive resort, those are already getting booked up really very quickly. So I think that's what comes back the fastest. What comes back the slowest is commercial real estate. Because I agree with you that some of the behavioral shifts induced by the pandemic are permanent. And that will affect business travel for meetings, for instance. That will impact the number of people working from offices, at least 5 days a week. And that will affect the way we shop. And so brick and mortar retail, I think, is in real trouble. And it is estimated that over the next 5 years, 1 in 4 of the nation's 1,200 largest malls will falter. So there's going to be a lot of empty retail space out there going forward.
Thank you. Some additional questions have come in. One specifically around our new administration and President Biden with tax policy on a moving forward basis. How do you feel that is going to impact the economy, considering the changes that that we're all expecting to be coming down the pike?
Yeah, so one of the things that we learned from the American Rescue Plan Act was that the Democrats don't need one Republican senator to support them, not even one. So who controls tax policy in America? It's not Joe Biden. It's Joe Manchin, the senator from West Virginia, 6'3" tall, 73 years old, and the very youthful Kirsten Sinema out of Arizona, who I believe was born in 1976. These two senators are Democrats, but they're conservative Democrats. And I don't think they're going to allow a progressive agenda to move through Congress, but what they have been demonstrated to favor are policies that are somewhat left of center. And if the Biden administration is able to tie those proposed tax increases, corporate tax rate back up to 28%, for instance, so halfway between the 35% pre-Trump and the 21% during Trump, increases in capital gains taxes, increases in the highest margin income tax rates, I think that's coming. And obviously what that means is the financial professionals who work with people who have assets to protect and defend, they're going to be even busier going forward because people are going to need them even more. But I think those tax increases are coming. But I don't think they're going to be massive because I don't think Joe Manchin or Kirsten Sinema will allow for massive tax increases. But there will be some.
Thank you. Another question that came in centers on commodities. And the question is, commodities have been beaten up for decades. Do you see this sector roaring back?
It depends on the commodities. So commodities have been beaten up for decades in some sense. So you might remember that back in 2008, there was a period during which oil prices in North America rose to around $147, $148 a barrel. Today, we're at $59.53 on a barrel of crude oil in North America, West Texas Intermediate. So, and gold, stuck it in the 1700s, for instance. That's the commodity price. Obviously, some of this has to do with Chinese manufacturing capacity of steel and iron and so on and so forth, aluminum. But, what I would say is this, that we have seen some meaningful commodity price increases lately. So softwood lumber prices have skyrocketed. Were skyrocketing last year. For the third and fourth quarters of last year, we saw some upward pressure on steel, tin, oil, natural gas, iron ore, aluminum, copper. And if I'm right that the global economy comes storming back later this year and into 2022, the supply chains are not ready for that tsunami of demand to come. So I think you might see some real upward tilt in commodity prices later this year and into 2022. And already some of that has occurred. That's what the laws of supply and demand tell me.
Thank you. I do not see any additional questions. We're going to give people about 10 or 15 seconds if they would like to submit something else. I do have a question that I've never heard an economist address, and how do you feel about Bitcoin?
I feel deep regret because I should have bought more of it. So I don't understand Bitcoin. I understand blockchain technology. And lately, I have a Coinbase account, and I've been buying not just Bitcoin, but Ethereum and Litecoin and Numeraire and Stellar Lumens and some of these other cryptocurrencies. But I do not fully understand. In fact, I don't understand at all from where they derive their value. But I understand this: millennials put value in that increasingly Bitcoin and other cryptocurrencies are replacing gold as a store of value. This is the perfect setup for gold prices to take off. In an inflationary environment, lots of money printing, global economy about to come back and generate rises in inflation expectations, and yet gold has stumbled because Bitcoin has taken its place as a store of value. And so, what can I do? Today, we had an announcement that a major auto company will now accept Bitcoin as payment. And so this is gaining more currency, no pun intended, from the perspective of the mainstream economic activity. You've seen what Elon Musk did, for instance, recently. So I think Bitcoin is here to stay. I think it's overvalued. I think it's a bubble. But I think cryptocurrencies are going to be part of our portfolios forever now.
Well, Anirban, thank you. That was interesting. I've already received some comments that this was an excellent presentation. Once again, you do not disappoint. I want to thank you so much for your time. That was terrific.
My pleasure.
Thank you. So what's next for Agency One? On Wednesday, March 31st at 3 o'clock Eastern Time, we are going to be hosting Brooks Tingle, Chairman and CEO of John Hancock Life Insurance. Brooks is going to provide commentary about a number of areas, including what is happening on the product front, how COVID has affected our industry, whether now is the time for optimism or are we too soon, and specialty markets that John Hancock has been pursuing and what they are experiencing in these specific market segments. Please mark your calendars for March 31st at 3 o'clock for this not to be missed session. These are my closing announcements for today. If you have any questions or would like additional information, please reach out to me, Gonzalo, Ed, or Dennis. Thank you for joining us. And with that, this is the conclusion of the presentation. Again, Anirban, thank you so much. Have a nice evening, everybody.
Thank you.